$1,000 is losing money right now, even if your balance hasn't changed. When I ran the numbers on a $1,000 bill sitting in a standard checking account for 10 years, the result made me stare at my screen for a full minute. In 10 years, that $1,000 earns exactly $1. That's what a 0.01% APY checking account does to money. And it's where most people keep most of their savings. There's a fifth scenario I haven't shown you yet, and it's the one that actually changed my behavior. I'll get there. You might be thinking, keeping $1,000 in a checking account is safe. Here's why that framing is the most expensive mistake in personal finance. By the end of this video, you'll know exactly what each of the 5 scenarios does to that $1,000 in real purchasing power, not just nominal dollars, and the specific number that explains why doing nothing is always a decision. Standard disclaimer: I'm not a financial advisor, and nothing here is personalized advice. The 10-year S&P 500 average I'm using is 10.7% annualized from macro trends. Inflation is 3.5% average annual CPI from the Bureau of Labor Statistics, both linked below. What I'm going to show you is opportunity cost, the money you lose not by making a bad decision, but by making no decision at all. Most people think of money in one category: safe or risky. Checking account is safe. Stock market is risky. That framing sounds responsible. It's not, because it ignores inflation, a silent cost that never shows up as a line item in your account. Wait, I need to show you this number because it stopped me cold. A standard checking account at 0.01% APY earns $1 on a $1,000 deposit over 10 years. Not $100, not $10, $1. Meanwhile, inflation at 3.5% per year quietly removes purchasing power from that same $1,000 the entire time. The balance reads $1,001. But what that $1,001 can actually buy in year 10 is worth $708 in today's money. That's a $292 gap between what the number says and what the number means. I had $1,000 sitting in a checking account just because it was there, and I hadn't decided what to do with it. I told myself I'd figure it out when I had more time. That's what I did for longer than I want to admit. Then I sat down and ran the math on 5 scenarios. Same $1,000, same 10 years, 5 different places the money could live. Scenario 1, under the mattress. After 10 years at 3.5% inflation, real purchasing power drops to $707. You lost $293 by doing absolutely nothing. Scenario 2, standard checking account, 0.01% APY. You have $1,001 nominal, $1 in interest. Adjusted for inflation, $708 real value, essentially identical to the mattress. Scenario 3, high yield savings account, 4.05% APY. After 10 years, $1,000 becomes $488 nominal, $150 real. You're slightly ahead of inflation, $51 in real terms. Not nothing, but not wealth building. Scenario 4, S&P 500 index fund, 10.7% historical average annual return. After 10 years, $1,000 becomes $2,662. Adjusted for inflation, $1,1052 in real purchasing power. That means the S&P scenario produced $1,161 more in real purchasing power than the checking account on the same $1,000 over the same 10 years. With no additional contributions, that $1,161 gap is opportunity cost. It never shows up as a loss in your checking account. Your balance never goes negative. That's exactly why most people never fix it. That 5th scenario I mentioned at the start, that's it. The number is 1,761. That's what doing nothing costs in real purchasing power over 10 years on $1,000. But there's a catch, and it's one most people never see coming. It's not just about the return, it's about what you lose by waiting. The math I showed you assumes you invested on day 1. Most people don't. They wait for the right time. Every week that money sits in checking is a week of compounding that doesn't happen. Delay investing $1,000 by 1 year, and the 10.7% scenario produces $2,494 instead of $2,762. That's $268 less. Not because you did anything wrong, just because you waited 12 months. The $412 in inflation loss is visible if you know how to calculate it. But the $1,761 opportunity cost gap is completely invisible unless you run the comparison yourself. Your account never reads minus $1,761. That invisibility is why most people's money never moves. Let me tell you exactly what happened when I tried this myself. For 18 months, I kept $3,200 in my checking account. Money I hadn't decided what to do with. The market was too high in January. It dipped in March, and I thought it might keep falling. By summer, I was reading earnings reports for companies I wasn't planning to buy. The $3,200 sat there the entire time. When I ran the math on those 18 months, the opportunity cost was $480. But $480 for doing nothing except waiting landed differently. That was the moment I understood that doing nothing with money is always a financial decision. And historically, it's usually the most expensive one. Running this math raised a question I still haven't fully answered. How much should I keep in cash versus invest? And when exactly do I move money? I'm spending the next 30 days tracking every dollar decision I make. I'll show you exactly what the data says. Before I found the system that worked, I tried to time the market. I have to be honest about what that cost me. For 3 months, I researched. I read threads in R investing and R personal finance. I watched charts. I read earnings summaries for index companies. I was looking for the right entry point, a moment the market was obviously cheaper than it would be tomorrow. That moment never came. Moments like that appear constantly in hindsight and almost never in real time. The result, my $1,000 sat idle for an extra 3 months. The math on that delay, $27 in foregone returns, $27, 3 months of research to potentially optimize my entry by 1-2%, and the cost of waiting was eating into that optimization from day one. That failure is what led me to the actual system. Here's what the math says to do. Not advice, just the logical output of the 5 scenarios. Money you won't need for at least 5 years belongs in a diversified index fund, something that tracks the broad market. Money you need within 1 to 2 years belongs in a high-yield savings account. The $1,051 real purchasing power in scenario 3 is ahead of inflation. That's the correct tool for short-term money. And checking account balances should cover 30 to 60 days of expenses. That's it. Timeline determines location. Under 2 years, ISA. Over 5 years, index fund. The number that changed my behavior wasn't $2,762, it was $1,761. The gap I was giving up every decade on every $1,000 I left in the wrong place. I have more than $1,000 in checking. The math scaled up fast. Now, every time my checking account balance exceeds 60 days of expenses, that money moves. It doesn't sit. It either pays something down or it goes somewhere it works. That's the behavior change. Just a threshold, 60 days, above which money has a job. Running this math raised a question I still haven't fully answered. Specifically, how much should I keep in cash versus invest? And when exactly do I move money? I'm spending the next 30 days tracking every dollar decision I make, and I'll show you exactly what the data says. Subscribe so you see the results. I'm logging every transaction decision, every time I move money or leave it, with the reasoning and the math. 30 days, real data. I'll show you the output. If you want to go deeper on how index funds work, specifically the expense ratio math that determines how much of that 10.7% you actually keep, that's in the Money System playlist linked below. One action before you close this tab. Check your checking account balance right now. Subtract 60 days of your average monthly expenses. Whatever's left, that's the number to evaluate. You don't have to move it today. Just know what it is. If the 5 scenario math made sense and you want to see how index fund fees change the output, that video is right there. Watch that one next.